everyone, welcome back to the channel. I've been moving over the last few weeks, so I haven't put out much content, hoping to start getting more stuff out soon. Today, I want to talk about earnings and what we should care about when listening or reading them. There's a lot of times when a company announces current earnings and they actually beat Wall Street estimates, which sounds great. The stock price should go up, right? Well, not always, and it's not always clear why the stock might trade sideways or even down after a strong earnings announcement. Today, I want to help demystify this a bit. First, we need to understand what really drives a company's share price in the short term. There's some large macroeconomic factors that a company is actually unable to control, such as inflation, interest rates, or even unemployment rates. If a company beats earnings and the Fed announces a rate hike, the share price is probably going to decrease, and not just for that specific company you're looking at. Most firms in the S&P 500 will react similar to large economic reports. One note here is if it's a defensive stock like a CPG company that has relatively stable revenue regardless of economic condition, then they may actually not decrease as much as some of the others. So now let's pretend economic factors are to be ignored and move to specific impacts from actual earnings calls. So the next thing that drives the stock price in the short term is the company's performance. Every quarter, they will announce earnings, and this will be a large driver of how the stock price changes. So first, let's understand what it means for a company to beat earnings. Each company that is publicly traded will have a set of analysts that work at a bank and follow just about every move of that company. They will model out and build their own models to predict what they think these companies will do in the short term. For example, if we look at NVIDIA, we can see that Yahoo Finance is reporting there are 36 analysts who are making predictions for NVIDIA. We can see the average low and high estimates from these 36 analysts for revenue and earnings. Now, for a company to beat earnings, they must report their revenue or net income to be higher than what the consensus or average estimate is. For NVIDIA in Q2, the consensus estimate was $28.74 billion in revenue and 65 cents of earnings per share. Their actual results came in at $30.04 billion in revenue and 67 cents of earnings per share. We can see they beat both on revenue and earnings. So why did NVIDIA sell off after announcing earnings back on August 28th? The share price dropped from 125 per share to a low of 102 per share, before slightly recovering back up to 117, where it's trading at today. Well, it clearly wasn't them beating earnings that caused the stock price to drop. Most likely, it's their future guidance, which takes us to the next big thing to talk about for a stock price. It's based on a mix of current performance and future expectations. So while they may have lived up to their expectations for the current quarter, the future outlook has changed in the opinion of Wall Street. NVIDIA is a very interesting company. It's valued as the second or third most valuable company in the world, largely based on future expectations. So when they have had 100% revenue growth year over year, expectations tend to grow pretty quickly, and a modest forecast for future quarters can actually have an impact on the stock price. And I believe that's what has happened here. We are seeing revenue growth from a quarter over quarter perspective leveling off. From January of 2023, we've actually seen quarterly revenue increase from $6 billion per quarter all the way to $30 billion per quarter, which means in just over a year, their revenue has grown 5x. Now for Q3, they're forecasting relatively flat quarterly revenue at $32.5 billion. I think this is signaled that 15% quarter over quarter revenue growth may not be possible anymore. Couple this with the discourse lately around AI investments being overdone, as there's no path to profitability, and analysts start to paint a picture that AI investments may actually slow down and revenue may retreat in the medium term. So while you have the best quarter, if you don't provide guidance for the future that will be just as bright, then the stock will actually recede. Now, onto a quick second example, as sometimes a company could beat on earnings estimates, but not for the right reasons. GameStop just released their Q2 results, and to a lot of people's surprise, they were profitable. You would think this is great news for a company that has been largely unprofitable since 2018. You might even expect the stock to pop up a bit after this, But the opposite has actually happened. The shares fell from $23.50 per share to $19.50 after the announcement, and largely to the confusion of some Reddit forums. You need to actually read the income statement. GameStop as a business is still unprofitable, but what is profitable is holding $4 billion of cash and earning interest on that. This act alone turned their $22 million operating loss into a $15 million profit for the firm. While it's great they are profitable, you want to see durable long-term profits that can be replicated by running the business. After all, you are investing in a business, and you want that business to drive profits. So it's very important to actually read the financial statement and understand what if there was anything that actually skewed what is driving the profitability. There's actually a quarter where Ford had about a $10 billion profit that was driven largely by their pre-IPO investments in Rivian. Unfortunately, they never sold that position, so never recognized all of those profits, as the stock for Rivian actually eventually came cratering down. So anyways, that's all I had for today. I thought some recent movements were interesting based off earnings, and thought I'd provide my commentary on how I think about how the share price is going to react after earnings. Feel free to leave any questions or comments below, and I'll try to get back to you. Thanks so much.